Welcome to Morningstar. Tencent got approval to launch a new game and its revenue accelerated in the first quarter, making a strong bounce back to growth. Despite this, shares in Tencent remains sluggish, up only 2% year to date. Ivan Su, our senior equity analyst, covers this stock, and he is here today with us to tell us what he thinks. Hi, Ivan. The days of double-digit growth is back for Tencent, as you say. What are some of the highlights of the quarter?
Yes, Kate. There are really two main highlights coming out of the first quarter earnings results. Number one, we saw 11% year-over-year growth in Tencent's gaming revenue, and this comes after three consecutive quarters of declines. So we think this double-digit growth really indicates that the global gaming industry has finally worked through some of these transitional challenges that we saw over the past year or two. So that's number one. The second key highlight we observed from this earnings result was really the strong profitability Tencent pull in, right? 45.5% gross margin for the quarter, highest over the past 2 years that has been recorded. So we think the strong profitability improvement is really also an indicator that Tencent continues to work through its efficiency improvement and also cost-saving initiatives. And these plans continue to bear fruits, which have a positive impact on the company's bottom line. Overall, it was a very strong set of earnings release.
Despite the strong set of earnings release, the stock doesn't seem to gain much. Why is that?
Yeah, so we think there's also two reasons behind the sluggish share price performance following its earnings release, right? I think number one, I think some investors were expecting even stronger advertising growth coming from Tencent. You know, Tencent did 70% advertising revenue growth in the quarter. Some were expecting Tencent to post about above 20% growth. So there could be a slight disappointment there on that front. Number two, and probably is the more important point, is that we continue to see a pretty depressed investor sentiment in the Hong Kong market overall, right? Tencent shares do trade in a pretty volatile Hong Kong market, and its shares tend to be fairly driven by news headlines, whether it's about China's economic growth or the geopolitical tension between U.S. and China. So we think we think that a lot of these share price weakness we saw really has to do with just the overall weakening of investor sentiment in the Hong Kong market.
So this week, Tencent also received another single title approval in games. Does this mean the approval pipeline is now normalizing?
Yes, in fact, we've been saying that the game approval a cycle will normalize, and it has, and it continues to, it has happened, and it continues to be that way. So I think that really signifies that again, that we are seeing a normalizing regulatory landscape in China, and not just for games, right? But also on the fintech side, where Tencent is finally launching for the first time its consumer loan products, and the fact that Tencent it's allowed to launch these products is also another sign that these regulatory headwinds are fading.
Lastly, for the rest of 2023, what are some growth engines that will drive Tencent shares back closer to your 704 Hong Kong dollar fair value estimate?
Yeah, so fundamentals, we have a lot of faith in for Tencent, right? You have advertising growth that's set to accelerate with China's reopening. You have game revenue, which you just talked about, that's also set to accelerate as China approves more games and Tencent launches more games. And then on the investor sentiment standpoint, we are also seeing potentially signs of an improving geopolitical landscape, right? I think Joe Biden recently said that he expects relationship with China to improve very quickly. So I think further indications along that line will also help to improve investor sentiment on Tencent stock.
Thanks, Ivan. For Morningstar, I'm Caitlin.